Right now, somewhere in a room you'll never see, a number just moved. And because of that one number, your rent might go up. Your job might disappear. Your retirement might get pushed back 5 years. You didn't do anything wrong. You just didn't know this market existed. There's a market bigger than the stock market. Bigger than crypto. Bigger than almost anything you've heard of. Most Americans have never even heard its name. But it decides your mortgage rate. It decides if your company hires or lays off. It decides how far your 401k stretches when you're 65. It's called the bond market. And by the end of this video, you're going to see your entire financial life differently. Here's something nobody tells you when you buy a house. You're not just borrowing money from a bank. You're borrowing money that came from somewhere else first, from investors, pension funds, even foreign governments, who lent that money to the US government by buying something called a Treasury bond. That bond has a price. And that price moves every single day, based on how much trust the world has in the US economy. When that price moves, your mortgage rate moves with it. You never signed up for that ride. But you're on it. Let's say you're renting. You think, bonds don't affect me. I don't own anything. But here's where it gets worse. Landlords borrow too. To build apartments, to renovate, to refinance old loans. When bond yields rise, borrowing costs rise. And landlords don't absorb that cost. They pass it to you. That rent hike you got last spring? It didn't start with your landlord. It started months earlier, in a bond auction you never heard about. Now here's the part almost nobody connects. When bond yields rise, it becomes more expensive for companies to borrow money to grow. So they slow down. They freeze hiring. Sometimes they cut jobs. That restructuring your company announced last year? Look at the timing. Chances are, it followed a sharp move in bond yields. You thought it was about your performance. It wasn't about you at all. If you're still watching, this next part changes everything. Most people blame the Federal Reserve for all of this. Higher rates, tighter money, a slowing economy, the Fed did it. But here's the truth almost nobody talks about. The Fed sets one interest rate. A short-term one. The bond market sets almost everything else, mortgages, auto loans, long-term business loans. And the bond market doesn't wait for the Federation. It moves on its own, based on what investors expect will happen months, even years, from now. That means the real problem was never just the Fed raising rates. The real problem is that a small group of institutional investors, betting on the future of inflation and debt, are quietly setting the terms of your financial life before you even know what's coming. You've been watching the wrong headline this whole time. Now think about retirement. Bond prices and bond yields move in opposite directions. When yields spike, the value of existing bonds falls. Most retirement portfolios hold a mix of stocks and bonds specifically because they're supposed to be the safe part. But when yields rise fast, that safe part can lose value too. People a few years from retirement watched their supposedly safe savings drop in value, not because they made a bad choice, but because of a bond market shift they never saw coming. That's not a personal failure. That's a system most people were never taught to read. But that's not even the worst part. The US government has to keep borrowing, a lot. Every time it issues new debt, it has to convince investors to buy it. If investors get nervous about inflation, about how much debt is piling up, they demand higher returns to take the risk. Higher returns for them means higher borrowing costs for everyone else. For your mortgage. For your car loan. For the store where you shop, which borrowed money to stock its shelves. It's one connected chain. And you're standing at the end of it, holding the bill. So what do you do with all this? First, stop blaming yourself for financial moves that were never in your control. Layoffs, rate hikes, rent increases, these often trace back to forces way above your paycheck. Second, get intentional about timing where you can. If you're planning a big loan, a mortgage refinance, or nearing retirement, pay attention to bond yield trends, not just Fed announcements. The 10-year Treasury yield is publicly available and it's one of the most useful numbers in your entire financial life. Third, diversify your sense of security. If your retirement plan depends entirely on safe bonds performing exactly how they used to, it's worth a conversation with a financial advisor about how much that safety has actually changed. You don't need to become a bond trader. You just need to stop being blindsided. That number that moved at the start of this video? It's still moving right now. It always is. You can't control it. But you can finally see it. And once you see the chain, bonds to rates, rates to jobs, jobs to your family's future, you stop feeling confused by your own financial life. You start feeling like someone who finally knows the rules of the game they've been playing all along. The economy was never random. It was just never explained to you.